So those are the fake gold standards. Now, there was an interesting plan, I think which Guido Hulsmann supports. I think it was maybe been introduced by Henry Hazlitt. It was later picked up by Hans Sentholz and by Professor Timberlake, who I did criticize this morning. He actually was at one time promoted this plan. I thought, it's a step in the right direction, away from monetarism. It's called parallel private gold standards, okay, or a parallel private gold standard. Basically, you don't get rid of the monopoly fiat money. What you do is you allow individuals, and you give them the means, to make exchanges and contracts in gold. Now, how would that work? And Hazlitt and Sentholz's, and even I think in Timberlake's plan, you would abolish the Fed. Okay, you get rid of the Fed. Now, you wouldn't get rid of the Fed notes, and you wouldn't get rid of fractional reserve banking. You'd simply abolish the Fed, which means that you could never have any further increase in bank reserves or currency. Okay? They would be frozen. Right? So you do get rid of the agency that can increase these things, though the government, the Treasury could increase them if it wanted to. But okay, so you get rid of the Fed. And then you freeze the monetary base. Okay, there's no more Fed notes. There's no more Fed deposits, which are held by banks as reserves. All of that's gone. You then convert member bank reserve deposit accounts into Fed notes. In other words, if your bank is holding a certain amount of reserves as 10% backing for the checking deposits that you have, they would go and get Fed notes in return. So you got rid of the Fed deposits, you get rid of the Fed. The only reserve now is actual Fed notes, okay? And that's frozen. You can't change the number of them in the economy because there is no Fed to do that. Okay. Well, I like that. Now the Treasury has 260 million ounces of gold, which it stole from the American people in 1933, okay, when President Roosevelt forced all Americans to turn their gold in for Fed notes. You would either do one of two things. You would either give it away proportionally to a proportional amount of this gold to each American citizen, which, take an example, if you have 260 million citizens and there's 260 million ounces of gold, each person would get 1 ounce. Okay? Or you could sell it. Okay? But whatever you do, you have to get it into private hands. You would then abolish legal tender laws. In other words, people would no longer be forced to accept for their debts paper Fed notes. Okay? And you would make gold clauses in contracts enforceable. So if myself and Simon made a contract in gold, okay, that I would pay him next week for that scarf, 1/10 of an ounce of gold. I love that scarf. Anyway, so he gave me the scarf, and then I was going to pay him a 1/10 of an ounce of gold next week. I could not come to him and say, I'm paying in dollars, in paper dollars, because they're legal tender. They're not legal tender any longer, so I can't force him to take them in payment, as you can today, and the gold clause is enforced. Now, according to Sentholz, Hazlitt, I believe Guido, once you get rid of the legal tender laws and you get gold into people's hands, then you can have two monies. Then people can take the gold if they wish, and they can begin to deposit it in banks or have it minted privately and begin to use it. Now, I have an objection to this. I think it's a pretty strong objection. And Murray Rothbard has voiced an objection to this kind of a scheme. First of all, you get rid of the Fed. All right. The government can still, at some point, people are still tied to these notes. These Fed notes are dollars, okay, in their minds. So if there is some sort of national emergency, quote unquote, okay, if we expand the war on terrorism and they want to finance a greater deficit, or if there's a recession for some reason and they want to push down interest rates, they can, remember, this is just paper. They can have Congress pass an emergency exception to the rule that you have to have that these liabilities have to be frozen, and the Treasury can print them up and finance a deficit with them. Okay, So you don't get rid of the dollar, but more importantly, you don't get rid of the paper dollar. But more importantly, if it actually begins to work and these things are frozen for a time, why would people use gold? You and I and businessmen and you know, everyone in the economy think, calculate, compare in terms of dollars. So if you go back to the regression theorem, okay, somehow, if you want to get gold back into circulation as money and not just give it back to people, if you want to get it back into circulation as money, what you need to do is to make them think of gold as dollars again. How do you do that? You have to establish a link between the dollar and the gold. Under the parallel standard, all you do is that you have gold over here and you still have these dollars that people have been using all along. Right? So this is a potential problem with this. Okay? Now, I'm not as, you know, I'm still willing to entertain this as one way of going back, because no one has come up, I think, with the perfect way of going back to gold. This would work if we had a horrendous inflation. If we had a very, very bad, you know, hyperinflation, then people would have the gold in their hands and they would be able to begin to use it in exchange. But the whole point is to freeze the Fed notes and not allow inflation any longer. So I don't see how you would get gold back into circulation. Now, very interestingly, some of the free bankers have said, you know, initially they said, well, we want free banking. The Austrian free bankers like George Selgin, Larry White, Steve Horowitz, they initially said, we want gold as at the base of our free banking system. But then George Selgin said, you know what? And I don't think the others have said this, we don't really need gold. If we get rid of the Fed and freeze the amount of paper dollars we have in the economy now, then they can serve as the base of the free banking system. Okay? So we just have this paper. And if they wear out, then the government will replace only the ones that wear out and so on. Okay. So the problem is that it ignores the regression theorem, it ignores the fact that people love the dollar, are used to the dollar, and compute and calculate and exchange in terms of dollars. And secondly, it still leaves the Fed notes in existence, which allows government at some point, because people believe it's money, to increase the money supply, okay, by having the Treasury print up new Fed notes. All right. Let's take Ludwig von Mises' plan. Ludwig von Mises liked the currency school, but he just believed that they didn't go far enough. Remember, the currency school, what they wanted to do was, even though there were unbacked notes in circulation, they wanted any new note that came into circulation to be 100% backed by gold. Okay? But what they forgot was that checking account money is also part of the money supply. And banks can increase checking account money and cause business cycles that way. So von Mises recognized that, and he said he wanted a strict currency school gold standard. Okay, he put forth a plan in 1953 for the United States. Okay, in an epilogue to his book Theory of Money and Credit, and in it he said we should impose a 100% reserve on banks for all future checking account deposits and currency. If banks were allowed to issue banknotes, that also would have to be 100% backed. Okay, all new notes and all new checking deposits. Okay, whatever was unbacked at the time of the reform can stay unbacked, because it's really only the new injections of money into the system that pushes down interest rates and creates the business cycle. He also, at the time, Americans couldn't buy and sell gold. We only got that right back in 1976. But anyway, he wanted to reestablish the freedom of buying and selling gold. Once that was done, then there would be a gold market in the United States, as there is today, and we could see then what the price of gold would be. So after a period of time, okay, after let's say 3 months of a gold market, the U.S. government would announce that within another period of time, say within the month, the dollar would be convertible at whatever the price of gold was after 3 months. So if it was $400 per ounce, then you would announce that in 1 month, anybody who wants to come to the banks and convert dollars for gold at the rate of 1/400th ounce of gold for a dollar. Okay, so banks would then be buying and selling gold. That would be a genuine gold standard. It would be a fractional reserve gold standard, but it would be a genuine gold standard. He would establish a conversion agency. okay, not a central bank, but what he called the conversion agency, to buy and sell gold for dollars. Okay, so actually it wouldn't be the commercial banks initially that did it. It would be this conversion agency. Anyone who bought Fed notes to the bank or checks drawn on their checking account deposits at commercial banks, anyone who bought these to the conversion agency would receive gold coin at the rate of 1 ounce of gold coin to $400. Okay, or if they wished, they could sell gold for $400 to the conversion agency. The Fed would not be. The Fed could still exist, but it would no longer be able to buy any more government bonds or securities. In other words, it could not print up money to perform open market operations with. Okay. For some reason, he didn't say that we should get rid of the Fed. He said that the Fed could not interfere with the operations of the conversion agency. He would also have withdrawn all small denomination bills from circulation. And I guess he meant $1 bills and $5 bills, maybe $10 bills. And they could no longer be in circulation, so that people would have to use gold for small purchases. So gold coins would be in people's pockets. Now, of course, at the price of gold as it is today, that would really be impossible. I mean, you couldn't use gold for small purchases if an ounce is equal to $400. Okay. Well, there's a couple. Again, this is a good plan. This does not ignore the regression theorem. Now there's a link. The dollar is 1/400th of an ounce of gold. Okay, so there's a link between the dollar and gold. People can still think in dollars, but now their dollar is defined legally as a weight of gold. So I think it's better than the parallel standard parallel gold standard I talked about. But it does leave the old Fed notes in existence, and again, the government can increase them. Okay.